The City UK has just published its latest Sovereign Wealth Fund report. The organisation estimates that global sovereign wealth fund assets could reach $5.5 trillion by 2011 as inflows from trade surpluses and commodities exports continue. We're joined now by Marco Maslakovic, who's an economic research senior manager at the City UK, and we're pleased to say is in the studio. Marco, thanks for coming in. So tell us how this breaks down, because obviously we see a lot of higher oil prices, higher commodity prices. For some of these sovereign wealth funds, this is just brilliant. They get more money. Some of the sovereign wealth funds, though, have been through a tough time over the last couple of years. I'm thinking of some in the Middle East where property booms went horribly wrong. So where is the strength right now?
2010 was a good year for sovereign wealth funds. After 3 relatively flat years in terms of growth, their assets under management increased by around 11% to a record $4.2 trillion. About 2/3 of sovereign wealth fund assets actually originate from commodities exports, that is the rich Middle Eastern countries, the oil exporting countries, and about 1/3 from non-commodities, which is mainly Asian countries, primarily China. And basically what we're seeing in the market is a higher pace of growth of non-commodity sovereign wealth funds, of China in particular. China has increased its foreign exchange reserves from about $1 trillion in 2006 to about $2.6 trillion at the moment. And about half of this is being held in sovereign wealth funds at the moment. And if it continues to accumulate foreign exchange reserves at the pace that it has in recent years, we think that probably a bigger proportion of any additional funds will go straight into sovereign wealth funds, as they already have enough funds for official monetary policy purposes.
Okay, and how do you factor in the violence that we're seeing in the Middle East and North Africa into your assessments here? But do you make the assumption that ongoing violence leads to lower sovereign takings, or do you just assume that whoever is in charge of the country will be selling their commodities, and therefore they'll continue to have these high sovereign wealth fund levels? And do you make assumptions about which countries the violence spreads to and how much that impacts?
Well, I think the impact so far has been limited. I mean, if we look at the countries that have been affected by the global political instability, it's a few of these countries have their own sovereign wealth funds, and the City UK estimates that they manage about $150 billion in sovereign wealth fund assets, which sounds like a lot of money, and it is a lot of money. But it's actually only 3% of overall sovereign wealth funds assets under management, so it's a relatively small proportion. So I think the effects so far have been limited to that extent.
It's interesting, isn't it? I mean, if you think back to what sovereign wealth funds are actually meant to be doing, they were set up to provide diversification away from a concentration of perhaps single currency ownership, which occurred because maybe in Norway's case they only had dollars for oil. In China's case, it was their largest trading partner. But in a world that's increasingly become correlated, partly as a result of the way central banks have reliquefied the global economy, it's getting harder and harder for them to find places to put that money where they're not impacted by global macro trends.
That's right.
So how do they manage to achieve what almost seems impossible right now, to get some sort of diversification away from Federal Reserve policy making?
Well, as you say, I mean, sovereign wealth funds have been set up to transfer, well, to a large extent to transfer wealth between generations. And in order to increase that wealth, they're not going to have enough opportunities on their own domestic markets, because they're always going to need the large liquid Western markets, which will offer them more opportunity to increase their capital. And what we are seeing at the moment is that there is more diversification in the market. Sovereign wealth funds are coming back to the international markets following a period early in 2009 when they largely retreated to their own domestic markets because their own countries were starting to be affected by the global economic slowdown, and they had a string of high-profile losses.
That sounds like not very easy then, basically, from here. Anthony?
No, I mean, I think one of the interesting questions is clearly as a sovereign wealth fund, you've got two strategies. You either adopt a sort of pension fund strategy in which you have a diversified portfolio in which you have minority shareholdings and it's just like an institutional portfolio. Or alternatively, as some of the sovereign wealth funds have done, you actually buy assets, you know 100% of assets. Isn't one of the problems with the second of those strategies that for the people whose assets are being bought, there is now an overlay of political risk? Because you want to make sure that if you're being bought by a sovereign wealth fund, you're pretty sure about the stability politically of where the sovereign wealth fund comes from. You don't want to find that you fall into ownership you really don't like. So isn't there now a bigger political overlay for a lot of companies in which sovereign wealth funds are investing, if that investment becomes larger than a small minority pension fund style investment?
Yeah. Well, I think that's certainly a factor to consider, but again, I mean, if we look at the overall assets under management, actually 5 countries, Singapore, China, United Arab Emirates, Saudi Arabia, and Norway, control 75% of all sovereign wealth fund assets, and these countries are away from the political instability.
For the moment.
For the moment, that's right.
We'll have to get you in again if that changes.
Yes.
I mean, you can redo your report.
Yeah.
Fascinating thing. I mean, you've seen exactly that with assets that have been owned by Egypt and Libya.
Absolutely.
And companies that are sitting in those buildings that are owned by those,
it's not good,
like Aviva, have had a real problem working out who they pay their rent to, but also how they manage to communicate the messages that they're in no way associated with those funds, even if they happen to
generally used for political risk.
And yet a couple of years before that, there were banks in the West, you know, hanging out the begging bowl to that part of the world and saying, please help us, because our sources of funding have dried up, and now we need your help.
And indeed governments as well, not just banks.
Yeah. The question I think that would be interesting from your background is about, have the sovereign wealth funds now got smarter about buying assets that offer good value? Because historically they tended not to have a very mature team that really were outsmarted by the city professionals either in Wall Street or in London, and ended up quite often buying things at the top of the market. And I fear when we look at that commodity exposure today that they have, that they might be doing the same thing again.
Look, I think they are much smarter, and if you look at the quality of the people who are now running sovereign wealth funds, and not just the markets you've mentioned, places like Singapore where these are, you know, top people, they are much less open to the door-to-door salesman that used to be the case. Depending on where it is, the decision-making processes can sometimes be quite obscure. Yeah. So, you know, in different sovereign wealth funds there are different challenges, but I think the professionalism of the management is of a completely different order in the last 10 years.
Okay, we're going to thank you, Marco, for coming in. Good to see you this morning. Marco Maslakovic, Economic Research Senior Manager at the Citi UK.